Hello and welcome to the Investing Master Series. My name is James Boyd. Happy Tuesday to you, and also happy July 1st, second half of 2025. Let's go ahead and get started. And also, we got a big 4th of July weekend coming up, so hopefully you're getting geared up and ready. Just real quick, I'd like to welcome all of you: Amun, Don, Dom, BJ, Chex, Barat, and many others. Good morning to all. And just real quick, as we're getting started, we also have Connie Hill in the chat. So the two redheads are going to be taking care of you today, as we normally say. So also remember, you can follow Connie or myself on X. We do post educational content there. Now, a quick reminder as we get started, this class is on stocks, but it's also on options. So we try to have a balanced discussion there. Also remember, when we talk about options carry a high level of risk and are not suitable for all investors. Also remember, when we talk about examples, they are just that, and the information provided here is for general informational purposes only. Schwab does not recommend the use of technical analysis as a sole means of research. So it's also kind of nice to kind of know what the company does, and so we try to include some of that as well, and also some of the looking at the correlation of intermarket analysis as well. Also remember, our examples will be done in the Paper Money software application. Investing involves risk, including loss of principal. And also remember, when we talk about it, let's say short options, those can be assigned at any time up to the expiration, regardless of the in-the-money amount. So if you had a covered call, they could take the shares prior to expiration. You sold the put, you could be the buyer of the shares prior to the expiration. It's not just at expiration. Also want to give us a quick reminder that if you go to schwab.com/events, you could see our events going into the end of the year. The next events are going to be New York. There will be a 2-day event, first day technical analysis, second day option strategies. Also be in Chicago, okay, and also Washington, D.C. Sorry, it actually shows differently on my screen. Washington, D.C., the 12th and the 13th, and that's at the Ritz-Carlton. So check that out. Remember, if you just need to be a Schwab client. If you're a Schwab client, you could actually attend for free. Join us. So just real quick, we want to kind of really talk about really looking at, is there starting to be a change in the market? We know that in the last couple of weeks, technology and semis have been very strong. Kind of seeing a little pause in those here today. Kind of seeing a little change in what we've been seeing going up. We'll talk about that. And also, we're seeing kind of a little change from the index that's going up and also sectors, and we'll show that. We're also going to talk about some current positions and maybe considering covered calling those positions, okay? Considering how do we do that? And also, we're going to talk about exiting some of those positions as well. So let's go ahead here and let me kind of explain what I mean. So if I pull up, let's say, the index list, and by the way, this is not a bad way. You could make an index list yourself. So when I kind of said that, historically it had been really NASDAQ had been leading us, then it had been the S&P 500, and then it was the Dow Jones. But what we're actually seeing right now is something a little different, okay? If we were to kind of rank this, and I'm going to rank this by RS5, what we're seeing at the top right now is a little different than what we have been seeing. The Dow Jones, that's the one that's actually leading now. You're also seeing that if we said, well, where did the NASDAQ go? NASDAQ's actually dropped, okay? And you're going to see that if you look at where's the S&P, it's also dropped as well. So really the Lone Ranger, if you will, is the Dow Jones, okay? Now this had been number one. This had been number two. And those you're starting to kind of see a little pausing after they have pushed up pretty aggressively. The Dow Jones, you got to ask yourself, well, what's driving that movement to the upside? Where's the Russell? The Russell is still down here. It is still lagging. It's been lagging, okay? So if we kind of said, well, what is it? Let's kind of take a quick look at what does the Dow look like, and also the S&P. Since we're on the S&P, let's hold here. Is the S&P completely falling apart? No, can't say it's falling apart. It's just not going up like the Dow is, at least in the last couple days, okay? So if we look at the SPX, kind of a little pause. Could this be like a flag after the pull? Sure it could, but it's pausing a little bit. Pause does not necessarily mean bearish. The one that we actually kind of has, when we talked about the Fibonacci, we backed this off, we kind of drew this up. It's the NASDAQ, that really went up to the 161 extension. Some traders taking profit a little bit here. Is it completely bearish? Pulling back a little bit. Did it just come off a flag, a pull? Yes. Could it be in the flag? Yes. Bearish. It's a down day so far, okay, down 0.8%, but not really necessarily changing trend. Now, I want to kind of speak to something just real quick, because in the Paper Money account, we talked about the example yesterday of Dash, and we talked about adjusting we set a target, and we also talked about the stop loss, right? A conditional exit. As a follow through to what we talked about yesterday, you're going to see that Dash this morning at 7:35 my time or 9:35 Eastern, it really actually hit the target. If we actually went back and just looked at this just briefly, and we said, well, what did Dash do in the first 5 minutes? Now, why do I say 5 minutes? Well, because the order was hit out at 7:35. So if you look at this is actually where, let me back this off to a simple chart. You're now going to see that if I went to a 1 minute chart, you're going to see that really, here it is. Here we are at 7:35. It actually gaps up a little bit. There's the open, gaps up, and about 7:35, it goes to right there, targets out, pretty much hits the target. And then that stock was right around 748, and you're going to see that it really shed about $8 since that. Now, if you would have said, well, geez, I'm going to move my stop up in the morning. No, this is why we do it daily, right? So good thing we actually went over that, because that actually did fall about $7 to $8 from this morning's price, which was only 90 minutes ago, okay? That Dash was targeted out, okay, that we talked about yesterday. Now, if we actually went back to something just real quick, what does the Dow look like? Well, here's the Dow. Now, got to ask the question, what stocks are leading in the Dow space? Like what? Now, yesterday we did two examples. We said, hey, we're going to try to show an example buying on the dip, meaning buying on the red candle on Amazon. We showed that example, and what you're going to notice is it hasn't really bounced. The keyword is yet, okay? Kind of still holding from where it was yesterday. The second example that we actually did of that was Nike. And we actually said, hey, look, we're going to buy on the red candle after it broke out and the price is still above the moving average. That's where it closed yesterday. And if you kind of look and see, well, did it get a little push? It got a gap. It rallied from yesterday's close at 71. It actually went to about 74. That's a $3. I mean, we're talking about from yesterday's close. So in a 90-minute window, that was a $3 swing from close to the intraday high. Just want to kind of practice that a couple times, right? We've been seeing a lot of that lately. That doesn't necessarily mean investors take advantage of that. So far, Nike playing itself out, though, that was a cash secured put on that. That's still playing itself out. Now, so big takeaway here today, change in kind of who's leading the Dow Jones. Now, the one thing we want to kind of also bring up in terms of just real quick, if I pulled up, let's say the Dow Jones, said, is there any other stock that's really leading the Dow Jones? And I'm going to rank this by percentage change. One of the other stocks in there that's getting a pretty big push, and we'll see this from the sectors in just a moment, Amgen is up there, Sherwin-Williams is up there, okay, among others. Now, let's look at just real quick the sectors, okay? Now, we do include, if I look at sectors just real quick and slide this up, the big difference we're seeing also in sectors, this is not the same. If we look at, let's say, sectors, what you're now going to notice is the basic material sector is getting a little breakout. Now, you got to ask yourself the question, what's in base materials, okay? Now, if you said, I don't know what's in base materials, that's fine. We're going to go just a real quick scan. I'm going to go scan in, going to go by industry, materials, and this is really going to give us a picture of what industry groups are really in there, okay? Chemicals, construction materials, containers, metals and mining is in there, of course, paper and forest products. So now, are there any, let's say, industry groups that are leading that? Well, we're probably most familiar with, let's say, metals and mining, gold, silver, copper, things like that. We'll check on that in just a moment. But if we take a look at this, That's actually different, okay, than what we've seen. Now, if you look at, let's say, the staples, that's not a small candle here today. If we look at, let's say, healthcare, that's not a small candle. Is this different than what we've been seeing? Now, is anyone else thinking, geez, why is staples going up like that? Go back to that. Why is healthcare going up like that? Okay. Why are we also seeing, for example, if you look at, let's say, gold fell down last Friday, trying to reverse. We could even say that it's a little bit more flat, if you will. But if we also pull up and say, is it just gold? If we take a look at, let's say, silver, is silver still holding in there? Silver is still holding in there. We said probably keep an eye on probably copper more than those two. And if you look at copper, copper is actually over 5 and actually sitting here at 513. So precious metals, we're going to include that in the sectors, okay? When people want to maybe have a little diversification, if you will, some people like to hide out on precious metals. And so far you're seeing really probably, if we kind of ranked it, copper first, silver second, gold third, okay? But the big takeaway here is basic materials pushing, staples, and healthcare. And I'm even going to go back and kind of include the next one, which is not broken out yet, which is real estate, but it's right there. But notice when we see the staples going up, healthcare going up, and let's say real estate going up, what does that typically mean in terms of the VIX? Well, that usually means that the VIX is trying to come off the low and maybe starting to show a divergence. Trust me, our head is on the swivel, okay? We don't see that breakout yet. It's in between the moving averages, but normally if those lower beta areas like staples, utilities, healthcare, things like that go up, include real estate, volatility is expanding. We're going to keep an eye on it. It's not yet, but the sectors are starting a movement. Some investors might be saying, look, we've seen this before. We want to buy some areas that actually might have a greater chance to go up if there was a push in volatility, okay? Now, so any questions? So we said the Dow, the base materials, staples, healthcare, okay? And also precious metals probably are going to be focusing a little bit more on copper. Now, the one area that I did not mention is transports, okay? Don't forget those. We said those yesterday. That's a continuation from yesterday. Also remember that when we take a look at, let's say, transports, you got to really remember transports is heavily percentage is heavily focused in Uber. Now, Uber is not broken out yet, but it kind of has that U pattern, maybe trying to make a handle. Keep an eye on Uber as well. Now, any questions with that? Now, the comment was on home builders. Home builders breaking out as well. So something to actually add as well. Thank you for that. Now, just real quick. Yeah, so Kevin actually says defensive moves, right? When we kind of see these areas like the healthcare staples going up, it probably leads, if we pull up, let's say, technology, we know that there's been some huge moves in technology. And so what happens is sometimes what investors will do is they'll profit take in some of these areas, or they might be, let's say, at a maximum gain on some of those positions. And they might say, well, if I'm going to put on new positions, do I want to put on new positions in this area, or do I want to go into other areas that haven't moved yet? Now, could they do both? Sure they could, okay? Now, if I pulled up, let's say, SOX, well, you're now going to notice if we looked at SOX and said, is that bullish? Well, we're below both moving averages. So if someone says, well, James, the theses or the common denominators and setting up any bullish trades is I want to see price above the moving averages. We're not. It might force those investors to say, I got to go look for other areas that are showing price above the moving averages. And if they say, I want to still be in those areas, but they're not giving me the setup, those investors probably could rotate to other areas. Now, let's not forget here. Now, Connie actually teaches the class on ETFs on Monday. Just happened yesterday. It's not recorded. Kevin and I teach a class on Friday morning. It's not recorded. Guys and gals, nobody says you had to buy the shares. Someone could just say, look, I'm just going to buy the base material of the sector. I'm going to buy the transport sector. I'm going to buy the healthcare sector. I'm going to buy the staple sector. Nobody says you had to buy the shares or you couldn't kind of have both. Okay. So it's very important you really understand that. Now, I also want to kind of go back to an example just real quick, and I want to kind of pull up a couple stocks. And I want to kind of talk about, I'm going to kind of go back to the paper money account, and this is very important that we do this. It's not just about putting on new positions. So in our example, what we actually have is Cisco, okay? And what we're really looking at is, I'm kind of contemplating when we actually see, let's say, stocks that have been going up, 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 up. We have 100 shares of stock, and the stock is at 68.81. We know that many stocks have been really making that flag pull, okay? So what I mean by that is these stocks that have been going up, 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 and all of a sudden now the price is down below the moving averages. Well, wait, if we're down below the moving averages, what caused the price to go up? Price was above the 10-day moving average. Price was above the 20-period moving average. Now, remember, we've been talking about stops over the last couple of days. If we said, hey, I'm going to come in here and just adjust my stop, let me actually take this back to a 1-year daily chart. If we did this and I said, hey, I'm going to move my stop to that 8-day low, the thing is what you're going to notice is right there, I'm just going to move it and slide it up. And it's just going to be a slight move. The issue is that the stock could still fall from 68.81, where we are now, and it could fall down to here. The problem is if you let it fall down to there, that actually means that unrealized profit goes where? It goes bye-bye, okay? Now, if the investor has 100 shares, what might they consider? What could they do? If they actually said, you know, James, I don't actually like it when my prices get down below the moving averages. If we close here, we're closing below the 20-period moving average. Well, if the investor said, well, my gosh, we learned about things like covered calls. I have the shares. How do you do a covered call? How do you make it a covered call? Well, step one, we have the shares. Step two, all we need to do is just go in and say, could I just sell a call? Because if you sell the call and you have the shares, you would make it a covered call. Now, when we talk about doing covered calls, we normally talk about looking at the monthly options, 20 to 50 days to expiration. Now, what I'm going to do here is I'm going to come down to not the 18 July, because that's coming up in 17 days. We're going to click on this, go 15 August. Now, here's the thing is we're going to cancel the stop order in just a moment. And then what we're going to do is we're going to sell a call. If we think, look, there's a pretty good chance that Cisco could pull back, well, what we're going to do is we're going to sell in the money. Why would someone sell a call in the money? Why would they do that? Because they think there's a high chance of it pulling back. Okay? Now, wait, stop for just a moment. If we sell at 67.5 and we collect $3.10, that's like making up to 70.60. So is there still upside potential? There is from where we are now. Yes. If someone said, well, James, I want to sell the 70 and collect $1.80, well, then that investor actually has up to, if you include the premium, $71.80. Okay? So someone probably sells at the money, in the money, if they actually think the pullback is more likely and they want a bigger premium to be more protective. Still gives us upside potential. If someone says, look, I'm not as defensive as that, I want to have a higher potential upside, well, we could sell the 70s, lower premium. Lower premium equals lower downside protection. What is the protection? The only protection we really have is the premium received. How do we actually sell the call? Simply just click on the 67.5. Now, if we click on the 67.5, the bid price, creates a sell order. Do we have to sell the 310? No. We're going to actually try to push it to the 315. If we push it to the 315, all we're saying, if we have 100 shares of stock, we're saying sell one, 67.5, 315, confirm send. And that's all it is. Now, what we're going to do is we're making the position a cover call. We're selling in the money because we actually think there's a greater chance to fall down. If technology and semis continue to actually drop, here's also, if we take a look at this, you're going to see that this is also showing in this case that we actually have a position where we're trying to get a big premium to help push down the directional sensitivity of the stock. Okay. Now, what do we mean by that? Well, if we have 100 shares of stock and we sell a call that has a delta of 62 and it's negative, why is the delta negative? Well, because we're selling the call. And now if the stock goes down, we're going to try to be stingy in terms of giving back some of that unrealized profit. We're going to go ahead and say send the order. Now, the one thing we want to kind of do in this position is when that, now, by the way, if we did this in the IRA, it would have not allowed us to do this. It would have made us cancel the stop first and then, okay, sell the call. Now, what I'm going to do is once this order fills, I'm just going to say, look, buy the covered call back if we get to at or below 65.42. And I'm going to write that down so we can just remember that. Okay. Now, do you have any 100 shares of stock? Okay. Do you have any stocks that, for example, might be starting to pull back? Okay. How would you know they're starting to pull back? Obviously, price. Maybe the 10-period moving average is starting to change color, going from green to red. Maybe the price is slipping down below the 20. All of the above. So I'm going to kind of watch that and see if we can't get a fill. Remember, if we can't get a fill in the first 2-3 minutes, we're going to go in and maybe move the price just even by a nickel. We won at 315. The bid's right now at 310. We're still right there in the middle. Okay. Now, this is very important because you got to understand something. When someone has 100 shares of stock, that is the most bullish you can be because you have 100 delta. When we sell the call, what we're doing is we're going to go to the left, okay? And what you're going to see is when we sell the call, we're going to be reducing the delta by 62, and our delta now is like 38. Okay, now wait. What has a delta of 0? Well, it's like if you didn't have any position, you don't have any sensitivity to direction at all. So if you're super bullish, you say, look, I'm going to go out as far as I can to the right-hand side. Think of like acceleration in your car. If you went 100 miles an hour, hypothetically, man, you better be really focusing, okay? It could be potentially a bad outcome if you get the direction wrong. Now, the biggest thing is if we go to go from right to left, decelerating the delta, we're trying to slow down. We're saying, look, we don't think that direction is going to be in our favor. We think the pullback could be imminent, and we're trying to hold on to some of that profit loss. In this case, it's an unrealized profit, and we're trying to be stingy. Now, it's not filling. Now, here's the thing. We do not want to assume that it's going to fill. We want to verify that it fills. I'm going to go back down to 310, confirm send. All I did is I just moved it down by a nickel. Confirm send. Okay, now it fills. So how do we actually change the stop? We're going to actually click on the sell, right click. What we're going to do is cancel the order. So now the position is a covered call. 100 shares of stock, short call. Right click on those lines now, create closing order. And so now what you're now going to see is it's a covered call. Okay. And the other thing I want to bring up, remember we talked about the delta being less? Why is the delta less? Because when you sell the call, it's negative delta. And I'm right there. And now if the stock goes down $1, and I'll mark this here in just a second, it's not going to give back 100. It's going to give back about $38-ish. Now, create closing order, sell. Now what we're going to do is this is a condition order. When we say condition order, market, data GTC, going to click on that gear. We did this yesterday. We're just doing it again. And we're going to say, look, we're going to still hold the stop that we actually had. If Cisco goes down to 65.42, exit the position. Now, someone might be thinking, well, I thought you had a covered call. I thought this was all the way up to August. You got to understand, we're only using the covered call to try to offset the give back in some of the stock price. Okay? Now, what you're now going to see is sell the covered call if the stock gets less or equal to 65.42. So how much play do we really have here? Well, from here to here. It's about $3.30. If the stock goes down $3.30, it's going to exit the position. Okay. Now, if we also go back to, so this is point number one. A lot of times what happens is investors say, well, James, I have my stop right here. I'm good. But then they actually see the stock drop down and they say, James, I just gave a chunk of all my gains back. We're not doing a covered call with the intent to hold to August. We're actually having a covered call to try to have some unrealized profits left when it goes down to that stop area. Okay, does that make sense? Now, comment came back from someone who might have maybe been here a little later. What happened to the tech sector here today? The tech sector, I mean, if we looked at the tech sector, the IXT, and said, what happened to the tech sector? I mean, it's down 1%. Now, if someone asked us and kind of said, well, what happened to this area? You got to remember is the tech sector has been, it has exploded to the upside, right, to say the least. And after you get these big moves, do some investors maybe try to take some profit? Sure they do, okay? Now, you got to understand something is there might not be any profit left to make. So they might say, look, I'm not going to stay in the position if I'm risking the profit I have and the max loss. And you're going to see that in just a moment. So sometimes it becomes maybe, if you will, a forced trade to exit. Speaking of that, now I'm going to go back to just real quick. Let's say one of the stocks that we've actually been in the paid money count is Microsoft. Let me show you what I mean by this. So if I actually went to Microsoft, and again, we're going to be disciplined to what we've been talking about. If I actually went in and said, look, what I'm going to do is I'm just going to kind of look at the stops, and I'm going to go back and say, okay, what is the position in Microsoft? Okay, now if I went to, let's say, the IRA, and I said, okay, what do we actually have in Microsoft? There it is right there, short vertical. So remember I gave you a comment before that here we are with 17 days remaining. And we're sitting in a situation where we have 72% of the maximum gain, and that was before today's $4 drop in the stock price. Now remember, if you take a look at this, you could only make 27% left, okay? You have 72% in your hand, 73% in your hand, and you could only make 27% left. So sometimes when investors say, well, I can only make 27% left, I could close my hand and grab that 73%. Now you got to understand something is you could give back the 73% and risk the maximum loss. So why do investors get out? There might not be anything left to make. Speaking of that, what we're going to do in Microsoft is we're going to close the position down. The expiration has not a whole lot to do with this right now. Could we have been at 80% yesterday? And the answer was we probably were. We're going to right click on this, create closing order, and then exit the position. Now, why are we not rolling the position? It's a simple answer. Why are we not rolling the position? We're not rolling the position because the price is below the moving averages. Get it? Usually if the prices drop down below the moving averages, you're saying that could be a potential exit. We're going to create closing order, we're going to buy that back. Now, what I'm going to do in this case is I'm going to exit that position, okay? And you're now going to see confirm send, note the commission. So what happened in this trade is we got in for a credit, and we're giving some of that credit back, plus the commission. Send the order, and there it is. Now, what you're now going to notice is, just real quick, is what we could do, I won't spend the time, but notice there are 14 shares of stock here with 492 as well. Clearly, this would be an opportunity to practice stop adjustments and or identifying manual exits. What do we mean on manual exits? You know exactly what I mean. Moving average, the 10-period moving average turning red. Is it? The answer is not yet. If we, for example, pulled up, let's say, Is the 20 period moving average turning red? Not yet. Have we had a crossover? Not yet. So the answer is right now is we don't have a manual exit yet. But if someone said, James, I like to sell when the 10 period moving average goes red, could that happen today? The answer is yes. Okay. But it's not happening yet. So the investor would be moving up the stop adjustment. Where is the stop adjustment? And the answer is it's at 472-ish, 472.98 to be exact. So if we went in here and said, I'm going to move up my stop to 472, and by the way, where is it now? It's 20 points lower, 472.98. How long does that take? Not very long. Confirm send, send. Now it's moved up, and there's the stop adjustment. That's all it was. Now, we've been doing those the last couple of days. It's not new, okay? Now, the one thing I also want to kind of say just real quick and kind of showing this is Dash, for example, right here, which we already talked about this morning, but it's also in the IRA, that is at 90%. So the question kind of becomes is, so why do some investors sell sometimes? Because there might not be anything left to make, okay? We don't know that everyone has stock positions. Who said they had stock positions, okay? So we're going to come back in the Dash, take this, that's a short put vertical, right click, create closing order, buy it back. When we say buy it back, we sold it initially, going to give back some of the initial credit, confirm send, send the order. Now, I don't know about you, but that doesn't take very long, okay? Now, if we went back and also said, well, is there anything else that we could maybe, as Bill would say, administer to? The only other one that I kind of see that stands out a little bit is this AXP trade, and that is really the one. Now, by the way, the one thing we have not kind of mentioned is, well, wonder if you have like a trade that is up near a target area. You got 3 contracts, okay? And I'm going to go back up and let's kind of take a look at AXP before we talk about our new positions. Now, what you're now going to notice on AXP is you're going to see that we had a targeted area right at, let's say, 323-ish. Do you see that there? We even have our target levels there. Now, this is going to be a good example of what we just talked about yesterday. Now, what was the high price today? Answer, 320.78. Okay? What was the target price? 323. So we're trying to make that last $2. The problem is the stop is all the way down here. So what's the issue? Well, would you really try to make $2 and then have your stop way down like that, like 20 points down? We talked about that yesterday. All we're going to do is going to move that up. Now, if we were, let's say, what was the high price today? We're trying to make $2 more, 320.78, and I'm going to move that stop to 318.78. 318.78. I'm going to get about right there, about as close as I can. Send that order. Now, what you're now going to notice is, unless I zoom in on this, now my target is there and my stop is buttoned up right underneath it. Why? So we don't give it all back. Okay. Now, does the stop guarantee profit building? No, it doesn't. It's a trigger to sell. We don't know what it's going to be sold at. Okay. Now, the other thing kind of goes back to that's the stock position. But when we come back to this is if we have a long call vertical and we're going into that targeted area, could someone try to sell into that area of resistance? Say yes. So if we went back and said, well, what percentage of the profit do we have? Well, the answer is, if we take a look at this, we're sitting on about 49% with 17 days left. Now, it's up to you, right? If the investor says, well, I want a little bit more than this, as they lick their fingers after they ate 2 racks of ribs, they might say, well, how greedy do you want to be? Okay. Now, what we're going to show in this example is we're going to create closing order on the stock trade. We adjust the stop, still have the target. On the vertical, we're going to say, look, we're going to sell up in this area of resistance right here and now. Or we could do what we did yesterday, but I'm just going to say, how do you manually exit it? The answer is go confirm send the order. If you wanted to, just like we talked about yesterday, could you put a conditional order like we did and put the conditional order if it were to fall? Yes, that's exactly what happened with Dash yesterday. Now, you got to understand something is the higher these go, there's a good chance that it's probably going to hit a target if you have a target, okay? And so the goal is not to hold on to it and become a collector. The goal is to try to have it go up there and try to push the overall account value higher, okay? Now, what I want to do is, are there any questions with that, okay? So some of the takeaways that if I was listening to this, I would say, it seems like he's trying to impress upon my mind stop adjustments. That's a correct statement. It seems like he's trying to really have me practice this reward risk methodology. That's a correct statement. It seems like he's having me really watch for resistance levels and profit management. And do we actually have any gains that could be taken? That's a correct statement, okay? Now, what I want to do is also kind of come back to, are there any stocks that we might actually look at that might be kind of holding up a little bit? Now, I want to go back to NEM for just a second, okay? Now, NEM, we're talking about one of the stocks that is in the basic material space. And this one, if we take a look at this, you're going to see that we have shares on NEM. And what you're now going to notice is this old breakout area. Now, there are some investors that they say, James, I do not use the day's low. I like to use maybe just a visual horizontal support level, and I like to set my stop below there less 3%. Fine, okay? But even if we did that, that's still going to be moved up to 55.01, and you might do it that way, okay? But the moral of the story doesn't really change in terms of being disciplined, okay? And there it is. Now, what I want to do is, let's say the investor said, James, I want to try to maybe trade a base material, but I'm a little concerned about maybe could the volatility be expanding? Now, how many of you have ever been nervous about a position, about like you're entering and I don't want to get hit out for max loss? Has anyone ever been in that situation? James, I haven't been paying attention, okay? I've been on vacation, I whatever, work-wise, whatever, okay? Well, usually when we kind of get to this point, there's been opportunities to get in, right? And a strategy that some investors might want to practice when the volatility is low and maybe at risk of rising, the volatility of that is a caller strategy. Now, the caller strategy could be done as like you get in all at once, or it's a leg in strategy, meaning you have the shares and you then put on the collar. But really a collar strategy, if you put it on all at once, is very similar to, let's say, a long call vertical, a short put vertical. The difference mainly being is that you own the shares, okay? Now, this kind of takes away a lot of the fear of like, well, wonder if the stock goes down. Because what we're going to do in this example is we're going to buy the shares of the stock, okay? So we're going to buy the shares of stock. Now, what I'm going to do is I'm going to do this in the margin account. We have NEM, the shares right there. We got those, okay? I'm going to go to the margin account, and we're going to do step one. I'm going to buy the shares of stock. Okay, not too bad. If someone buys the shares of stock, what do you want the stock to do? Of course, you want it to go up. Well, so why would you buy the shares of stock? Okay, step number two. We're going to go down to advanced order. We're going to go first triggers SEQ. And what you're now going to notice is we're going to sell a call. Now, wait, hold on. If we have the shares and we sell a call, James, that's a covered call. Exactly. So we're just building on what we know. Now, typically what you're doing is you're selling a call where you think, where you wouldn't mind the stock to, where you wouldn't mind to sell the shares. Now, if you bought the shares at 58, would you mind to sell them at 60? No, there's some upside there, $1.40, and you get a bigger premium, okay? If we bought the shares at 58 and change, would you mind to sell those shares at 62? I like that better because there's more upside. Well, there's more upside, but there's less premium, so there's give and take here. But let's say the investor says, James, I want to sell that at 62.50, okay? Well, if they sell it at $62.50, we get a $1.54 premium. This is a covered call. The problem is this is an income strategy, but James, this does not protect the downside. So how do you protect the downside? Well, what you're now going to see is we're going to take that $1.54 and we're going to come over here and say, look, we want to have a right to sell the shares at 55, and we're going to take that premium and we're going to buy the put. So how do you buy the put? Just click on the put that you want to buy. Now let's put this on. Now your homework assignment is to do 3 of these. I want you to look for stocks that you don't mind in owning in the paper money account. I want you then to, for example, sell a call and then buy the put. Let me visually show you what this looks like on the risk profile. Okay, analyze the trade, back to the trade tab, right click, analyze the trade tab. So let's stop for just a moment, because if we kind of think about this, when you think about this position, a stock position should be a diagonal line. There's nothing new on this, okay? Now, if we were to take a look at this, what you're now going to notice is, there's your diagonal line. If we sold the call, there shouldn't be anything really new on that, because what you're now going to see is that line now goes flat. Why? Well, because you agreed to sell the shares for 62.5. But the last piece we really need to add to this, because now there's unlimited loss down to 0, is the last piece. What's the last piece? Right click, analyze that trade. And the reason why we said it's vertical like is because there's a max loss built into the trade. The max loss, what you're going to see is in the 55 strike. Why does the blue line go flat at 55? Because that's where the investor has the right to sell the shares. So someone asked me, well, why wouldn't I just do a long call vertical? Why wouldn't I just do a short put vertical compared to this? Well, what you're now going to notice is if we said of the Greeks, Delta, Gamma, Theta, Vega, why would someone do this type of strategy versus just verticals in general? Have you ever done a vertical and said, I'm just not as satisfied with when it goes up in my direction? I just feel like I'm making pennies on the dollar, if you will, when it goes up in my direction. The purpose of this, since you have the shares, the delta is bigger. Meaning the direction, you're at greater, if you get the direction right, the delta is higher. You could benefit more. Vice versa, if the stock were going to go down, you have a bigger delta, you're at a greater sensitivity, you could be down more. So some investors, if they feel like their technical analysis is superior to others, and we all feel like we do, right? They might want to choose a position like this where the delta is higher. But notice the option Greeks on these others, they're pretty much flat or benign. This trade is mainly focused on direction, okay? Now, what happens if, for example, the stock closes above 62.5 and you don't touch it? It should be exercised, meaning someone takes your shares at 62.5 and the 55 expires worthless. What happens if the stock closes below 55? Well, anything that's in the money should be exercised. Stock is sold at 55 and the 62.5 expires worthless. Okay? So really, what is the maximum gain on this trade? Well, we can see what it is. Right around 400 bucks. What's the maximum loss on this trade? Well, we can see it right on this, about a little bit over 300. Okay? So the goal, what do we want the stock to do? Clearly, we want it to go to the upside. I think a lot of people, when they first got started, whether they traded stocks or ETFs or whatever they did, if they would collar the positions and they would take down their emotions. And now you're it's like bowling, but you kind of have the bumpers in the gutter, okay? It can only get so good, there's a cap, and it can only get so bad, there's a floor, okay? Now, what I want you to do is to practice this. I think this strategy, when we talk about the collar, given where volatility is, this is not a bad strategy to practice, okay? Now remember, if we're talking about buying stock, it still needs to be a stock that's above the moving averages. If you say, James, I found a stock, but it's below the moving averages, then we wouldn't talk about buying the stock below moving averages. Still needs to be a stock above the moving averages. I want you to practice 3 of these. Notice we sold the call out of the money, meaning above. Notice we bought the put out of the money, meaning below. Your homework assignment is to do 3 of these. I want you to also look at your stop adjustments like we've been doing. Practice looking at reward to risk as well and kind of clamping down on those stops as well. And also look and see, are there any positions that could be profit taken on, okay? And let's go confirm and send, and we'll send that order. Now, I'm out of my time here today. Stay tuned for Cameron May coming up next. Thank you, Connie Hill, for answering those questions in chat. And also, there has been a survey, and thank you so much for that. Keep an eye on the Dow Jones and some of the rotation that we are seeing in the other sectors. Yes, we are seeing that. And also remember, with what we discussed, it was done for example, illustrative purposes only. You got a homework assignment, 3 different kind of steps of that. Go out and practice it. And this has been the class on Investing Master Series. Thank you so much. Take care. Bye-bye.